Case scenario 17 now, it is on income from house property, tax calculation, return of income and advance tax. So mainly income from house property. Miss Hetal transferred to his name, her husband, Mr. Hemant, a residential property worth 45 lakhs located in Nagpur without any consideration. Now, one spouse is transferring to another spouse without any consideration a house property, then provisions of section 27 clause 1 will be attracted. In this case, though the ownership is transferred to Hemant, Hetal only will be deemed to be the owner. It is a case of deemed ownership. If you recollect house property chapter, towards the end of the chapter we had discussed 6 situations where 27 section will be applicable. The expected rent of such property, we don't know whether it is let out or it is self-occupied. The expected rent of such property is 5 lakh rupees. Municipal tax of 5,000 is paid by Ms. Hetal for this property during the previous year 22-23. It has been paid, therefore it will be allowed to be deducted. 5,000 I am putting in bracket. Ms. Hetal has 3 other residential properties in Mumbai. So this property is located at Nagpur. Though it is transferred to husband Hemant, it will be deemed to be Hetal's property, and Hetal has 3 other properties also located in Mumbai. So now she is the owner of 4 properties. We know pretty well any 2 properties can be self-occupied properties. All remaining extra properties will be, if not let out, will be deemed to be let out, DLOP. However, which properties will be deemed to be self-occupied and will be deemed to be let out, that will be completely at the option of the assessee. Hetal has to decide whatever is most beneficial to her. The expected rent from these 3 properties situated in Mumbai is 10 lakhs, 11 lakhs and 12 lakhs respectively. 10, 11, 12. She purchased the properties out of her own funds. That means they are not gifted by husband. They are out of her own funds. Municipal taxes due are 15,000, 20,000 and 25,000. Therefore not paid, therefore no deduction. No deduction will be allowed with regards to Mumbai based properties from municipal tax. Same have however not been paid this year in respect of the 3 properties that we know pretty well. It is due, that means not paid. The expected rent is less than the standard rent in case of all the aforementioned properties. So these 3 properties seem to be self-occupied or lying empty. Ms. Hetal does not have any other source of income from any other source. Okay, so out of these 4 properties belonging to Hetal, including Nagpur property under section 27(1), we will have to make a choice which property to be considered as self-occupied, which 2 properties to be considered as self-occupied, and which remaining 2 properties to be deemed to be let out. Further, that was Hetal's story. Now Miss Hetal's father, aged 58 years. Now this is the story of her father. This paragraph is dedicated to her father. Had capital gains of 5 crore from sale of house property. Assuming it is long-term capital gain, he reinvested the proceeds from sale in another residential house for 4 crore 98 lakhs. This will make him eligible to claim exemption under section 54. However, they have not clarified whether this capital gain is long-term or short-term, because section 54 exemption is available only in case of long-term capital gain. So institute has forgotten to clarify, but we assume it must have been long-term only. And the remaining sale proceeds were deposited. How much will be remaining sale proceeds? 2 lakh rupees out of 500 lakh or 5 crore. 4 crore 98 lakhs is the investment made. LTCG is 5 crore, and under section 54 4 crore 98 lakh will be the exemption. 2 lakh rupee will be the balance taxable. This 2 lakh rupees he has not invested in capital gain account scheme, he has deposited in savings bank account. So this 2 lakh depositing in savings account will not entitle him for any kind of benefit or any kind of exemption. Only 4 crore 98 lakhs, that is 4.98 crore, will entitle him for section 54. This balance amount is not deposited in capital gain account savings scheme. It is deposited in a regular savings account. He has paid 1,50,000 towards LIC premium. He has no other source of income. Now since he has no other source of income, this 1,50,000 would entitle him for ATC deduction, but ATC is not available against 2 lakh rupees of long-term capital gain. What is the status of this balance 2 lakh? Balance 2 lakh is still long-term capital gain, and chapter 6A deductions are not allowed against any special income taxable at special rate or against any long-term capital gain. So 1,50,000 will lapse. Since he has no other source of income, this 2 lakh will be taxable, but it is less than basic exemption limit of He is 58 years of age, so basic exemption will be 2,50,000. Now resident individual, assuming he is resident, this unexhausted basic exemption limit of 2,50,000 can be set off against long-term capital gain, and accordingly the taxable income will turn down to be zero. This is the story of Ms. Hethal's father. Proceeding further, third paragraph, Ms. Hethal's grandfather. Now the story of grandfather who is age 81 years. That means super senior citizen. Assuming he is resident, he has interest income on fixed deposit of rupees 6 lakhs. He has no basic exemption limit for him will be 5 lakhs. He has no other income during previous year 20 to 23. He has to fly to USA for his treatment of cancer on 31st July 2023, and his return of income is not yet filed before flying to USA. What will be the due date to file the IT return? Due date to file IT return will be 31st July 23 itself, and till that day he has not filed IT return and he is leaving for USA. So I'm sure the question would be whether he is required to file IT return or not. So answer is technically yes, because his income is greater than basic exemption limit. We will just check it out. This entire paragraph is dedicated to grandfather. First paragraph is for Hethal, second paragraph is for his father, for her father, and third paragraph is for her grandfather. What are the questions asked? 17.1. What is the amount of income liable to be taxed in the hands of Ms. Hethal under the head income from house property? Now Hethal has got 4 house properties. Out of 4 properties, we will have to decide any 2 can be treated as self-occupied at the option of assessee, and balance 2 will have to be deemed to be let out, DLOP, and then rental income will be chargeable to tax. So let's just calculate it out. But before that, just glance through the details. First property is Nagpur property. From Nagpur property, expected rent is 5 lakh rupees, and there is a municipal tax 5,000 paid. And Mumbai based property, the expected rent is 10 lakhs, 11 lakhs and 12 lakhs respectively. So 5, 10, 11 and 12. For municipal tax for Mumbai property is not yet paid, it is due, but for Nagpur property it is paid, therefore 5,000 will be allowed to be deducted. So first of all, we'll have to calculate the NAV of all the 3 properties and then work out accordingly. We'll have to take a call. Whichever property has got the least NAV, lowest NAV, those 2 properties will be deemed to be let out, and those properties which have got higher amount of taxable value or higher amount of NAV, those will be deemed to have been let out. Deemed to be self-occupied. So the story is this way: Nagpur property, Mumbai property 1, Mumbai property 2, Mumbai property 3. How much is the expected rent? ER. Expected rent is lower than standard rent. So ultimately, if taxable, if offered to tax, the amount taxable will be 5 lakh, 10 lakh, 11 lakh, 12 lakh. Less municipal taxes paid. For Nagpur property 5,000 has been paid, will be allowed, but for Mumbai property 15,000 is not paid, 20,000 not paid, 25,000 not paid. So NAV will be 4,95,000 for Nagpur property, 10 lakh rupees from Mumbai property 1, 11 lakh rupee from Mumbai property 2 and 12 lakh rupee from Mumbai property 3. Now based on NAV, before claiming standard deduction, we'll have to take a call which of them to be treated as SOP. So those properties which have got highest taxable value, namely this and this, Mumbai property 2 and 3 will be self-occupied, will be assumed to be self-occupied, or we can treat them as self-occupied. Accordingly, the taxable value NAV will be nil. 11 lakh can be saved from taxation because NAV will be nil. Standard deduction will also be nil, and only interest will be allowed, but there is no interest on housing loan. As far as Nagpur and Mumbai property is concerned, they will be deemed to have been let out. Standard deduction will be allowed from both of them. For Mumbai property 1 it will be 3 lakh. For Nagpur property we'll have to calculate it out. 4,95,000 into 0.3, 148,500. 148,500 will be standard deduction, which will subtract because they are deemed to be let out, therefore notional income will be chargeable to tax. 4,95,000 minus 148,500, 346,500 will be the taxable income. 346,500, and from this property 7 lakh will be the taxable income, and these 2 properties income will be nil. So total income chargeable to tax will be 10,46,500. Let's check whether this is one of the options or not. Yes, option B, 10,46,500. Our answer is option B, 10,46,500. Let's check what's Institute's answer. Institute's answer for 17.1 is also 10,46,500. Our answer is correct. Let's jump to 17.2. What would be the tax liability of Ms. Hethal for the AY 23-24? Compute in a manner so that her tax liability is minimum. Now whenever the question says compute in such a way that a tax liability is minimized, that means somewhere we will have to apply 115 BAC, then the tax liability can be reduced. So let's calculate it out. Tax calculation will be this way. Now income will remain 1046,500 only whether 115 BAC is opted or not. Many people are under a wrong impression that standard deduction is not allowed if 115 BAC is opted. Answer: that is only for salary chapter. Salary standard deduction and income from other sources standard deduction from family pension, these two places standard deduction is not allowed if opting for 115 BAC. However, so is not the story in case of house property chapter. Standard deduction will certainly be allowed. Income will remain same 1046,500 whether 115 BAC is opted or not opted. If 115 BAC is opted, then income remains 1046,500. Still, first 2,50,000 tax will be nil. Next 2,50,000 at the rate of 5% tax will be 12,500. Next 2,50,000 at 10% will be 25,000. Next 2,50,000 at 15% will be 37,500. And balance 46,500 at 20% will have to calculate it out. 46,500 into 0.2, 9,300. 9,300. The total tax thus will be 75,000 plus 9,300, 84,300. 84,300 plus 4% health and education cess. Surcharge will not be attracted because income does not exceed 50 lakh rupees. 84,300 into 0.04, 3372. 3372, and accordingly total tax liability will be 672, 87,672, rounded off to nearest multiple of 10 rupee, 87,670. Let's calculate without 115 BAC. If 115 BAC is not opted, then the income will still remain 1046,500. First 2,50,000 nil, next 2,50,000 at 5% will be 12,500. Next 5 lakh will be taxable here. Next 5 lakh will be taxable at 20%, unlike 2,50,000 slab. And the balance 46,500 at 30%. 46,500 into 30% will be 13,950. 13,950 plus 12,500 plus 1 lakh is equal to 1,12,500, 126,450. 1,26,450 plus surcharge here also will not be attracted, but health and education cess at the rate of 4% of 126,400 will be attracted. 126,450. 5058 will be health and education cess. Taking total 5058 plus 126,450 will be 131,508. 131,508 rounded off to the nearest multiple of 10 rupee will be 131,510. Which tax provision should be opted for to minimize tax liability? Answer: 115 BAC should be opted. 87,670. 87,670. Answer C for 17.2. Our answer is 87,670. Institute's answer is also C, 17.2, 87,670. 17.3 is Hethal's father required to furnish his return of income for the AY 23-24. What is the story of Hethal's father? Hethal's father's story is given here. Father is 58 years of age. He has got 5 crore of long-term capital gain. Out of that, 4 crore 98 lakh rupees is exempt under section 54. Taxable capital gain is 2 lakh, which is within basic exemption limit. So tax will be 0. Agreed, tax will be 0. But when you come to IT return filing chapter, in case IT return, who has to file? So every other person other than the above mentioned person, one of the point was, whose total income before claiming exemption under section 54, 54B, 54D, 54EC or before claiming chapter 6A deduction is more than or has exceeded the basic exemption limit. Now after claiming exemption under section 54, the income is 2 lakh rupees, but before claiming exemption under section 54, the income is 5 crore. Therefore his father will be required to file IT return. IT return will be required. So what is the answer? Answer is yes. The first option is wrong. 2, B, C and D. Yes, is required by 31st July, by 30th September, by 31st October. These two are wrong options. Correct answer is B. Why 31st July and why not 31st October? Because tax audit will not be required. In order to attract tax audit, which will have 31st October as a due date, tax audit will be attracted under section 44AB if the business turnover exceeded 1 crore or 10 crore or professional gross receipt exceeded 50 lakh and not the amount of long-term capital gain. Our answer is B, 31st July. Institute's answer for 17.3 is also B, 31st July. IT return is required. Our answer is correct. Now proceeding further with 17.4 is Miss Hethel's grandfather required to pay advance tax during the previous year? Advance tax is payable only if the final tax liability, according to section 208, final tax liability after TDS TCS, final tax liability exceeds 10,000 rupees. However, section 207 subsection 2, senior citizen not having PGBP income, first condition senior citizen, second condition resident, and third condition not having PGBP income will not be required to pay tax in advance. They are required to pay tax but not in advance if the person is resident plus senior citizen. Now Hethel's grandfather is 81 years of age, so he is definitely senior citizen, or in fact very senior citizen. So what's the story for grandfather? Grandfather has got only 6 lakh rupees of income. Grandfather 81 years of age, 6 lakh rupees of fixed deposit interest income, no other income. But he wants to fly to USA on 31st July 23. He has not filed his return of income. Agreed. But then question is not asking about IT return filing. Question is asking whether he has to pay tax in advance or not. So answer is not required to pay tax in advance. So correct answer is no, he is not required to pay tax in advance since he is a senior citizen. This is correct, but that is not enough. Senior citizen norm, he should be resident senior citizen not having PGBP income. Yes is a wrong answer. No, he is not required to pay advance tax since he is a senior citizen and he is not having any income under the PGBP. This is the correct answer. And D point is yes, he is required to pay advance tax. Wrong answer. Our answer is C. Let's check what's Institute's answer. Institute's answer is also C. With that, our answer is correct. With that, this MCQ or this case scenario 17 comes to an end. See you in the next video with case scenario 18.